What I want to talk about in today's video is flexibility with whole life insurance policies designed for maximum cash value. Now, when I say flexibility, I'm not talking about initially designing a policy with the base premium, the PUA rider, like we frequently talk about. We'll hit on that in this video, but I'm mainly referring to flexibility after you start a policy. So we can always talk about how to design a policy for maximum cash value, which is a lot of fun because that's really where the gold is at when you look at how these things are structured, what company to use. But what if you've already started a policy? Or what if you're considering one now and you want to know, hey, if everything goes according to plan, that would be great. But what if something comes up after the fact that I just can't think of right now? Or perhaps you already have a policy and something has come up after the fact, as most of us have been through before many times. What options do I have available? I will say that the initial design is very, very important. The better the policy was designed, the more options you likely have. But what I want to hit on today is what options can be available with whole life insurance policies after you had already started a policy and you need to adjust course because life happened and you cannot pay the amount in that you originally thought that you could. So what we can adjust here, I'm going to hit on two things. One is adjusting the actual funding, meaning I started out paying X amount of dollars. I don't have that dollar amount anymore, or I'm dedicating funds elsewhere, so I can't fund the policy. Can I adjust that dollar amount? The answer is yes. And then the other part is adjusting the death benefit, which has to do with the overall insurance expenses. Can I adjust that death benefit after the fact? The answer is yes, but there's some things I really want to be aware of, particularly if I'm laser focused on cash value planning. I want to make sure I don't trigger a MEC, a taxable event. So let's begin with adjusting the funding. What can I adjust here? The base premium and the PUA rider. We always talk about this. When designing a policy, where can your money go? Toward the premium or the PUA rider? Premium dollars typically do not show up in cash value initially in the first year, sometimes the first and second year with traditional policies, whereas PUA dollars have them in cash value. I can access that, and that's what accelerates the overall growth on cash value in a life insurance policy. With those two items or those two areas where your money can go, the base premium is typically not as flexible. After you start a policy, if you would like to increase the base premium, which would result in increasing the death benefit, some companies do allow it. However, you'll often have to go through medical underwriting to do that, unless you have a company and product that has a face amount increase provision built in. MassMutual's old legacy products have that, which allow you to increase the face amount, the overall death benefit, which increases the base premium. You can do that in segments over time, which was a nice feature with that product. They might have it available with the new one. We don't really use it that much, but some companies and products do have that available. For the most part though, if you wanted to increase the base premium on an existing policy, more often than not, medical underwriting will be required or you will not be able to do it. Some companies will just say, no, that's not possible. This is where a new policy would be suitable. The PUA rider, that is extremely flexible. That you can elect to add money in 1 year, the next year add zero, maybe you add a partial amount. It can be designed where it's extremely flexible and you can adjust those payments over time. When talking about policy design and flexibility, a lot of people like to set up a policy where if they're paying in, call it $100,000 per year, or I should rephrase, if they want the ability to pay in $100,000 per year, they'll set it up where their base premium is $10,000. That's what they'll commit to. It might be $11,000 or $12,000 with a term insurance rider, but they're committing to a minimal amount, and then they add additional funds into PUAs at discretion. And when they add those additional funds, they see them in cash value as well. They can access it if they want. That's really how they accelerate the cash value growth. But we design it to be very flexible. This way, I can pay up to 100, but I'm not billed for 100. Same is true if I only want to pay a maximum of 10. I can pay up to 10, but perhaps I'm only billed for 1,000. Making the product very flexible. So base premium dollars, difficult to increase, possible in some cases. You can decrease the base premium by reducing the death benefit. Companies will almost always allow you to do that with a variety of products. Only thing you have to be aware of there, I'm going to hit on that in the next point too, is if we adjust the premium downwards, the death benefit comes down. We've got to be aware of the MEC test and the MEC limit there. So always important just to have our finger on the pulse of the company, the product, everything, or I should say the agent that you're working with has their finger on the pulse of the product, company, industry, and can make you aware of what to do and what not to do. So limited flexibility, to summarize, PUA dollars, maximum flexibility. How to adjust the death benefit? Can it be adjusted? So the whole life death benefit, this has a direct relationship to the base premium. Difficult to increase, easy to decrease, but we need to be aware when we actually make whole life death benefit, it's referred to as face amount decreases, that we don't run into a MEC or a taxable event. This will have to do with how much we've paid into the product in prior years. Term rider, same is true here. We can easily reduce, we can partially reduce or cut the term rider altogether, which often we do when we set policies up for maximum cash value. We're carrying that term insurance usually for a limited number of years, where eventually we want to drop it. We can drop it earlier than planned. The only thing we want to be aware of there again is, will we run into a modified endowment contract? Depends on when we do it. If it's during the first 7 years, we really want to look at it carefully. If it's after the first 7, we could be fine dropping the term rider without a MEC, unless we're still max funding it. So MEC is what we want to be aware of with decreases. But regarding the ease of adjustments, it's always easy to decrease the death benefit on a policy, whether it's a whole life death benefit or a term rider. When it comes to increases, more often than not, some type of medical underwriting will be required, or it just makes sense to start an additional policy at that point in time. Really depends what we're trying to accomplish there. But if it's cash value planning, we're going to look at all of the options and then select the one that is in the individual's best interest. What I want to hit on next is a case study we're going to look at. This is going to be fun when we look at the numbers and the different funding scenarios regarding his flexibility. We've got a 45-year-old individual. His plan is to pay into a policy up until the age of 60 or through the age of 60. He wants to fund up to $100,000 per year. Now, of that $100,000 per year payment, his base premium is 10%, exactly $10,000. We do have term insurance riders attached as well, which net his total out between $12,000 and $13,000 per year, his total minimum, but his minimum base premium is $10,000. Plan is to pay into it for 15 years. Life happens, we're going to assume. He has to change course after he starts the policy. Now, he doesn't have to pay in zero. He can pay in zero, but he's saying, I'm not going to pay in zero. I can still pay something in, just not the original plan 100 grand per year amount. So I've got to change course. What does it look like if I reduce my actual dollar amount? So he is paying in $100,000 per year initially. There's the funding. What happens if I have to reduce that? If it's only $20,000 per year, for example, what's the impact there? Then what happens if life gets a little bit better? And I can start to make larger payments again. We're going to look at that. Or what does it look like if things go south real fast and I can't pay anything in? Maybe it's only after 2 years and I plan to fund it for 15 years. Or maybe it's after 5 years. So seeing these options are nice. And really the purpose of seeing these options, they're meant to demonstrate what is possible with a whole life insurance policy if it is properly designed. And also with one of the major mutual companies, but a lot of companies, in addition to the major mutuals, will allow you to make these adjustments as the years pass. All right, let's have some fun. So we've got the man with the plan on the far left, which is the 45-year-old individual. It says 46 at year 1. That represents his age at the end of the first year. 100 grand goes into the policy. What is his cash value in the first year? 100,000 in, cash value, just over 88%, $88,000 in change. Death benefit, almost $1.7 million. That gives him a MEC limit. Death benefit has a direct relationship to the MEC limit of about $110,000. So we overinflated this one a little bit. Year 2, pays in $100,000 again. Cash value, the net increase that year was 88, went up to 183. It's about $95,000. Where he paid in 100, meaning he lost $5,000 in year 2 if we isolate the payment versus what the cash value grew by or didn't grow by in this year. Next year, however, pays in 100, gets the 100K back, plus approximately another $2,000. What's highlighted in yellow represents his break-even point. when he has more money in cash value than what he has paid into the policy. Year 5, he's positive. Between years 4 and 5 is when we really see it. And he continues to fund the policy up until age 60 or through age 60. That's how long he wanted to pay into it. 1.5 million in, a little under $2 million in cash value based on the present dividend interest rate. After the funding, we had a term rider attached. We removed the term insurance rider, which is optional. He could partially reduce it if he doesn't want to see a big fall off here, but he says maximize the cash value and long-term death benefit. So we cut the term rider altogether, and the cash value continues to appreciate without any more payments. Looks good. The man with the plan. Now, life happens. He can't pay quite as much money in. Let's say he really has to reduce the dollar amount to $20,000, right? So his plan was to pay in $100,000 per year for 15 years, and something came up. He can't make the payment anymore. Maybe he's disabled. Perhaps he had a waiver of premium rider on where it still waived his base premium and he paid a little bit extra in here. But whatever it is, he cannot pay $100,000 per year for 15 years. What is going to happen to my policy? Because I planned for A, something unexpected occurred. What will my money look like? That would be my question in that particular case. So here we go. We talk about the design. So this video is about flexibility. If he wanted to pay less, he could easily pay just the base premium and term rider in this example, which would be between $12,000 and $13,000. We just rounded it off to $20,000 per year. So he's paying the minimum premium plus a little bit into PUAs. Break-even point still between years 4 and 5. If you're able to max fund a policy in the first and second year, that puts you in a position where it's very difficult to fail. You're going to see the last example in this video toward the end of it. We look at that where it's a policy only funded for 2 years. But being that the worst years of a life insurance policy are the first and second year, if I'm able to max fund that policy up to the neck limit the first and second, I put myself in a very, very good position where if life does happen and I can't pay anything into it, I don't have to worry about things imploding, meaning the policy lapsing. I'm forced to take a loan against the policy to pay the premium for itself. These options here, when you see no payments going in, it's going to be a premium offset, meaning the dividends and interest are going to pay that premium for me. Not on this example, on the next tab when we get there. Point is, first 2 years are critical. So here, he just continues to pay in $20,000 per year, breaks even at the same point in time between years 4 and 5. And that is because of the first 2 years, just to be very, very clear there. If we only max funded it in the first year, that break even would fall between years 7 and 9. If I'm much younger, it'd be close to year 6, but in reality, it'll be between years 7 and 9, based on the non-guaranteed values. First 2 years is important. So, doesn't look bad here. Continues to appreciate. He has the option to pay in more than $20,000 each year. Maybe bounces it up and down, but this just shows $20,000. Instead of getting a total of $1.5 million into the policy, total of $460,000 into the policy. What does he have in cash value? $600,000 in change. Death benefit, $2 million. Next year, when we reduce the term rider, $1.3. We could have reduced the term rider earlier. We kept it higher in this example, and we would keep it higher if the individual states, I still want the option to be able to raise my payments again, like this guy. So this is fun. A lot of people aren't aware of this. I remember a mentor of mine, the first time I showed him this with this company, he's retired since, but with the company that he works with, we showed him a big catch-up payment in the illustration software because we had clients that have been doing this, so I showed him it. And he's like, I didn't know you could do that. And he's been with the company since I was born. But he's like, that's pretty cool. Send me that. The point is just, it kind of creates the aha moment when we're not aware that we can do this kind of stuff, flexible funding with a life insurance policy. Because what's the base premium on this policy? $10,000. What's the MEC limit on this policy? Just over $100,000. I'm going to pull up the illustration quickly. But look at this. Life happened, but got a little better later. So he pays in $100,000, years 1 and 2. Cash value is identical, cash value death benefit for that matter, identical in the first 2 years in all 3 examples. because it's the exact same policy. The difference here, $20K per year. Then year 10, check this out. Circle this in gold. What happens to the payment here? Makes a big catch-up payment. Maybe he receives an inheritance, sells a piece of property, has $250,000, can be any dollar amount, but just slugs a ton of money into his policy, making up for some lost time. Now, he exceeds 10x the base premium here. Through experience, when we're making large catch-up payments like this, making up for lost time, companies do not have an issue with this. What's important is that we don't go through medical underwriting. In order to do this, you need a 1-year term rider in many cases. Because what you'll notice here is when we dumped this large PUA payment into the policy, look at this. Death benefits 1.945, death benefits 1.945. With those 1-year term riders, when you dump money into PUAs, we see the cash value benefit. Our whole life death benefit does go up, but we have a term rider embedded in it as well. I'm going to pull up the illustration in a second, and that term rider goes down proportionately. Let's take a look at that actually, because if I said that, and if I'm watching this video, I would kind of say, what? I don't really follow that. But again, I'm slow with a lot of this stuff. So here's the policy. As we look at this guy, so we've got a $10K minimum base premium. I'm not going to walk through the design. I do that a lot, and sometimes I'm repetitive too much. But here we go. 100K, years 1 and 2. This is the exact scenario we just saw in the Excel sheet. In fact, we pulled the data from this and imported it to the Excel sheet like we always do. There's your death benefit. Okay, years 1 and 2. I'm at 183 at year 2. 20,000 per year. Year 10, 250 goes in. There's my cash value. Here's what I want to look at. See death benefit in the far right? What's the column immediately next to it read? Remember that OYT, 1-year term rider? There we go. So what happens is as we're pumping money into the policy, naturally with a whole life policy, my death benefit goes up. At the same time as the whole life death benefit's going up, my term rider is going down. What these 1-year term riders allow you to do, if I make a big PUA payment like this, in order to avoid the insurance company from putting us through underwriting, if it just buys down the term, then I do not need to go through underwriting. Here's what I mean when I say this. If I didn't have a 1-year term rider and I throw in $250,000, that's going to buy me almost at his age between 6 and 700K approximately an additional death benefit. Normally, a life insurance company will say, hold up, why are you suddenly making this huge payment? Did you just find out that you were diagnosed with a terminal illness of some sort? And you're trying to cash in for your beneficiaries? We'd like you to go through medical underwriting before we accept the money. This happens very frequently. If a policy is set up properly, in this particular case, a 1-year term insurance rider, that allows us to make this big catch-up payment, experience the cash value benefit, and it buys down the term proportionately. Now, long-term, I will add, this does enhance your overall death benefit. If we go back to the Excel sheet, we'll see this, the comparison sheet. So here, at the end of the funding here, year 10, your death benefits. They're identical with these two. But what happens as time passes? Well, because you've got more money in cash value that's just stewing for you over time, that naturally is going to push up your death benefit. For example, look at age 70. You're at 1.846 compared to the example where you've paid in $130,000 less over a longer period of time, you're 1.5, focusing on the death benefit there. But interesting example, right? When we look at what we can do with the policy, let's look at, so that's adjusting funding downwards. And then one example, things got a little bit better and we increased it. Let's see what it looks like if we stop funding altogether. So another life happens scenario. So going back to this guy, or to the next page, I should say, we've got everything going according to plan, things look great. This is the 15-year funding scenario. There we go, the 1.5, almost $2 million in cash value. However, what does it look like if I stop funding altogether? We'll assume after 5 years. So I've gotten a total of $500,000 into the policy. What do you notice on the difference here at year 5? Is there any difference? No. The reason why is because it's the identical policy. All of these options are. What we're doing is taking that one policy and modeling what things would look like if we have to adjust after we start as the years pass. It's much easier to design different options here to say, hey, I can optimize a 5-pay or a 2-pay or the bouncing payments up and down if that's my planned scenario. But we always plan for option A, and then option D happens, or option Z, something that we don't expect. So we want to have the assurance that we can make these changes and adjustments, I should say, as the years pass. What's interesting about this one, look at your year 8 death benefit in both examples. The scenario where you keep funding it, what do you notice here? Death benefit keeps going up. We kept the term rider on because we continued to pay into the policy. How about this option? Year 7, what was your death benefit? 2.420. And the big drop. In fact, it stopped, or it really slowed down in growth after we stopped paying into it. Continued to appreciate over here because we keep on pumping money into the policy. But here, we kept the term rider on for 7 years. 7 years has to do with the 7-pay test, which is another name for my MEC test. There we go. And then drop the term rider after that point in time. So we don't have a term attached anymore. We also got rid of the base premium with the reduced paid up option. Then let's look at one more. Life really happens. Now what? What do things look like? Well, the first 2 years were still identical because we got 100K in years 1 and 2. How about after that? Nothing goes in. What do the policy values look like? Keep on going up. Breaks even between years 5 and 6. Very close to year 5. 200K in, 198 in cash value. Assuming the dividend rate never changes, which it will over time. It always has gradually over a long duration. But values continue to grow, where I've only paid in a total of $200,000. Point. We can make adjustments as needed. Policies can be designed to be very, very flexible. It is important to be aware of different companies' flexibility, features, limitations. What can I do? What can I not do? If you have the awareness there, or if your agent has the awareness, everything can be set up so you can adjust as time passes. And you do not have to pay in $100,000 or $1 million per year for this to work. This can work if I'm paying in $50,000. Maybe it's $10,000 per year. It's all relative from a policy design standpoint. If you have questions, please feel free to leave them in the comments below or email us direct. And if you enjoyed this video, please hit the like button, subscribe for more. And as always, I hope this helps. Thank you so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.